More weak labor market data. What does it mean for the Federal Reserve? Let's ask Kevin Mahn of Hennion Walsh Asset Management. Kevin, the Labor Department's Bureau of Labor Statistics today estimated that 911,000 fewer jobs were added to the U.S. economy than previously reported for the 12 months through March. What do you make of that figure?
Yeah, that is a massive downward revision with 911,000 fewer jobs that were created over the last 12 months than we had originally thought. Nearly 1 million jobs less were created over the last year. I think that's going to give the Federal Reserve another reason to be concerned. We have to go back to June. After that meeting for the Federal Reserve, they raised their forecast for unemployment to 4.5% at that time. We're around 4.2% right now. They also lowered their forecast for GDP growth to just 1.4% at that meeting, believing that we were going to stay below 2% economic growth for the next 2 years. But all of that was with the presumption that we had 911,000 more jobs that were actually created. So with this new revised figure, I'm very interested to see what the Federal Reserve is going to do after their September meeting. Yes, in all likelihood, they will cut interest rates by 25 basis points at that meeting. But they still have 2 meetings remaining in 2025 after September. We're also going to get an updated summary of economic projections from the Federal Reserve after this meeting in September. If, in fact, now they've raised their forecast for unemployment even higher and lower their forecast for economic growth even more, that begs the question, are they behind the curve and late to the party once again? I still contend that they should have been cutting interest rates back in June if they truly were data dependent. Of course, they remain concerned about inflation and the potential inflationary impact of tariffs which remain somewhat uncertain right now with a large number of countries.
And this Thursday, we get the latest inflation data with the Consumer Price Index report. So with the Federal Reserve now seemingly focusing more on the labor market, how do you think the CPI will factor into the Fed's decision making?
I believe that the Federal Reserve is more concerned right now with the deterioration in the labor market and the potential add-on risk to the economy than they are with the inflationary impacts of tariffs. Remember back in April, the initial tariffs tantrums, when the fear over the extent of tariffs was much higher than it is right now. Now everyone is settling into this roughly 15% range for tariffs, and we haven't seen any immediate large inflationary impact as a result, whether that's because the actual companies are absorbing those tariffs and not passing them on to consumers, or consumers aren't accepting those higher prices and choosing to keep the money in their pocket or search for alternative lower price goods. I believe that these tariffs present more of a growth scare than they do an inflation scare, because if consumers do keep the money in their pockets, the economy will slow further. The Federal Reserve recognizes that. So I'll be paying close attention to additional inflation reports between now and next week's Federal Reserve meeting. I think that 25 basis point cut is already baked into the markets now. And now I believe that the markets are starting to price in a rate cut in October and a rate cut in December to close out with 3 rate cuts this year, as opposed to the 2 rate cuts that the Federal Reserve was forecasting as of June.
With the economy slowing, are recessionary concerns back on the table?
I believe at this point in time, everything is on the table. More so stagflation, though. I'm going to go back to June once again in terms of the Fed's updates to their summary of economic projections at that point in time, when they raised their forecast for unemployment to 4.5%, when they lowered their forecast for economic growth to 1.4%. And they also raised their forecast for inflation using their preferred inflation gauge of core PCE at that time to end the year at 3.1% before coming back down to 2.4% next year. Higher inflation, lower growth, more unemployment is the recipe for stagflation. I don't think we're going to get there, though, because I think they're miscalculating the potential inflationary impacts towards tariffs at this point in time. If they do arrive and at least cut interest rates 2 times, I believe that we avoid a recession and some of those stagflation concerns start to dissipate over the course of 2026.